Today's last session is session 4, which will be talking about tax advantage capital sources for real estate development. My name is Mark Cooter, and I'm a tax partner and leader of Cherry Bekaert's Real Estate and Construction Industry Group. We're excited to have those of you who have joined us earlier in the week back, and for those of you who are joining us for the first time, welcome. Our virtual conference has featured 4 presentations on a variety of hot topics and recent developments and proposed updates tailored to the real estate and construction industry. And we hope you've enjoyed the lineup thus far. For those of you who are joining us for CPE credit, here's some quick housekeeping before we get started. First, to receive CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. If after 10 days it has not been received, please email cbhlearning@cbh.com and they will make sure to handle that for you. A short survey will be posted at the conclusion of the webinar. That is just for our purposes and just to get feedback of how what you thought of the content and the presentation today. A recorded version of this webinar will be available in about 1 week. It will be sent via email and posted to our website. If you have any questions during the webinar, please type them in the Q&A window through your virtual screen located in your control panel. And with that, I'm pleased to introduce my colleagues, Laurel Tinsley and Pete Byford with the Tax Advantage Group by Cherry Bekaert. They have a lot to review and discuss regarding various tax credits, tax-enhanced equity, and other tax advantage sources of capital available for use in real estate development. Pete and Laurel.
Mark, thanks so much for having us. My name is Pete Byford, and I am with the Tax Advantage Group by Cherry Bekaert, and spend most of my time assisting projects in developing alternative sources of capital for their projects, including through the use of the sale or distribution of excess tax credits. And Laurel, I'll let you take a moment and introduce yourself.
Good morning. Hope everybody is feeling well on this wonderful Friday morning. I'm Laurel Tinsley. I'm with the Tax Advantage Group by Cherry Bekaert. I'm the managing director. In that role, I help all of the different team members in their jobs of raising, managing, and deploying capital. We work with CDEs and QualiBs. We work with projects across the country, and we are really excited to tell you a little bit about a couple of tax advantage sources of capital today. Back to you, Pete.
Thanks, Laurel. And so today we're going to try and cover a whole lot in 1 hour. So we'll move quickly, but feel free to type questions into the Q&A box and we'll be happy to respond as best we can in real time. And then we'll hopefully have a little time left at the end. But we are going to give you a quick overview of just the typical capital stack components, just review traditional sources, talk about tax advantaged sources that you may or may not be familiar with that can help build your capital stack. And then we've got a sample project that managed to cobble together almost all of the sources we're going to talk about today, so you can see how they interplay with one another. So with that, we'll dive right into it. You guys are all probably pretty familiar with the basic capital stack. You've got traditional equity, senior debt, and then from time to time, subordinate or mezzanine debt to fill out the basic financing of a real estate project, and just sort of a representation of how that might stack out in a typical deal. We talk about equity, we're talking about the sponsor or the developer's actual cash in the deal, additional partner assets. If you have a partner that's coming in with the land already under control, putting sweat equity in order to help with the development of the project, or a contractor who's discounting fees for a piece of the back end action, developer fees that are deferred, those types of things are what we would consider typically equity in the transaction from the sponsor developer team. Third party equity, lots of folks, you've got friends and family deals, you have a small group of investors who like the projects you do and invest capital from time to time, even into small private placements, and then larger use of investment funds that are looking for projects of the type you're developing. And obviously those third-party investors are typically going to have preferred return requirements, maybe some control rights, and then there'll be a flip at some point once they've been repaid and the developer takes over the primary or the majority of the remaining proceeds from the transaction. Senior debt, that's going to be your typical bank lender that's taken a first priority mortgage, either through a construction loan or a construction to perm loan. That might be your perm life lender on the back end of the construction of the project. And then subordinated debt or mezzanine debt are typically going to be lenders that are going to charge higher rate, take more risk, and take a subordinate position, lien position in the collateral behind your senior debt holders. Those could be CDFIs or other non-bank lenders. They can be investment funds, individuals, really a range there, but they're typically going to be folks who are looking for a much higher yield for a higher risk position. And you guys know most of those. So a softball question to start off, our first polling question, which of the following is not a type of equity? We'll give you all a few minutes to start answering that question, and then we'll move on to our next one. Looks like we're about 75% there. All right, looks like we need about 10 more responses and we'll be ready to go. Perfect. So looks like we have all of our answers in, and then we had a question about discussing mezzanine funds as preferred equity versus debt. And so we won't dive too deep into that, but a lot of what we typically think of as mezzanine lenders are willing to, again, depending on the returns they receive, come in as actual equity rather than debt, which takes them out of the collateral stack from the position of having collateral in a foreclosure event, but puts them into the equity ranks where they're earning a preferred return on the proceeds of the deal, and are typically going to take a higher preferred return either along the way or as a portion of the back end on a disposition from a more of a debt position where they're simply earning an interest rate based on repayment. So, and we can dive more into that towards the end if we've got a little time, but Laurel, I'm going to let you jump into some of these tax advantaged sources.
Good morning, everyone. So there are multiple types of sources that can work together to bring projects together. We're talking about real estate development today. And so really that covers, just to be clear, the gamut, but we're not focusing on housing tax credits today. So we are talking about opportunity zone equity, federal historic tax credits and state historic tax credits, the plethora of other state incentives that you should go out and find in your neck of the woods, and then new market tax credits. So the next slide really focuses on opportunity zones. Unfortunately, if you're just learning about this now, which I'm sure you're not, you're a little bit late to the party. If we don't get our investments in, we're going to run out of the window for getting these investments and having the deferred the reduction in capital gains and some of the benefits there. From all the I've seen about the Build Back Better and other legislation that's going through right now, this is not something that they're trying to address currently, but I have seen a lot of positive feedback on the ability for this program to be extended. So I would say this is not a hot topic right now, just based on the runway we have for the legislation. But check back next year or keep looking at the legislation and see if there are other incentives that come out. And this will be one of those that either gets reauthorized in some form or could get married in with other programs, but it has had a very positive feedback from a lot of people. So I believe that we'll see it come back in some form.
Yeah, and Laurel, I think we had a panel earlier in the week digging really deep into the opportunity zone benefits. And so we certainly would encourage folks to go and check out that as well if you want to dive into all of the details there.
Good point. Thank you. I forgot to mention that for people who weren't here yesterday or the day before when the opportunity zones were talked about. I think if we want to move on to federal historic. So the federal historic tax credits have been in the code for quite some time now. And they are currently under code section 47. They used to be a few years ago, a credit that you could take all at place in service. And now they are one that is taken over the 5-year compliance period. That has been something that the Historic Tax Credit Coalition and others have been lobbying to put back to the way it was. For those of you who haven't done historic tax credits for a while, but used to do those, that has really changed the realization on the credits, but they're still a really impactful program. The federal historic tax credits are, as they would imply by their name, for redeveloping existing buildings that are historic in nature. They either have to be, and I'm not sure, we may have another slide about that. We either have to be on the state register or on the federal register of historic places, or they have to significantly contribute to their district. So the buildings are then rehabilitated by the developer, and you get a dollar for dollar tax reduction because it's a tax credit. So that is one of those things that on occasion trips people up, is that it's a tax credit. And so it goes typically to an investor. So you can develop some of these on your own, and there are all sorts of restrictions about who can and can't take credits, and the lovely little profit motive that pops up there. So we typically see these as a structure where there's a development entity and also an investor that comes in. A lot of the investors are corporations or investors that are bank related, and they are available to be taken in all 50 states. So Puerto Rico, I believe, even just had their first historic deal done not too long ago. So I think they've made their way around pretty much everywhere. And I know that in Greenville and a lot of the district downtown has been done with historic tax credits. So I'm sure a lot of you are familiar with that already. If we want to hop to the next slide, Pete.
And we're at our second polling question.
Great. So the second polling question is, what is a SHPO? I'm just going to go ahead and say it the way I say it, SHPO. I love that Pete did not try to make these hard on you guys. So remember, we're talking about state historic, or we're talking about federal historic tax credits, and we should have one of those answers pop out. I don't know if Pete, we're getting some pretty good responses.
We're getting close.
Already.
Yep. We right now we've got one question, number one answer leading, but we do have some strong, at least a couple folks who enjoy humor.
Yes, I think if you think it's the strong hippopotamus polling office, you are probably attending this as a requirement. Yeah, so 3% of you are here today because you need your CPE credit, which is fine. We will get you there.
Exactly. So we'll move on.
So the credit equals 20%. I'm sorry, I'm still laughing over the hippopotamus. The credit equals 20% of the qualified rehabilitation expenditures. As I teach a class on this, I always like to tell people what that basically means is you can get credits for things that are permanently affixed. So if you've got carpet, you need to tack that down instead of just and glue it instead of just lay it down. Things that are permanently affixed. So we're talking about rehabilitation of a building. And so that's another one that trips people up on occasion. I had a lovely project who tried to convince me they could do their dam. And I showed them the picture of on the Department of Natural Resources page where they said, no, bridges do not count because they are not structures. So you must have a building that has to have sides and a roof to take the credit. And I was just ahead of myself, apparently a slide. So this is where it lists that they have to be on the National Register of Historic Places, on a state or local register, and then or significantly contribute. So if you are on a register that for a building that significantly contributes to your district, that would qualify you in as well as being on that national register. So there are some places that are on the national register that don't know about it, because that is something that can be done by a prior owner. And so that's something to check out. And there's a list that you can go and see if your building is there. And the last part of it is that you have to actually take a substantial rehabilitation, which means that you have to follow on some minimum thresholds for your rehabilitation to make sure that you qualify for the credit. So what are QREs? I told you, you have to make sure it's permanently fixed, because there are also development costs that can be qualifying there. You can take credits for things that are capitalizable to the building. So for example, if you have a lawyer or an accountant, you can take some QREs for those expenditures, but they have to be expenditures in connection with the redevelopment of the building. So if you're doing your tax returns and you're also having your accountant help you with your historic rehabilitation, the work that they're doing for the cost certification and helping you with planning and modeling, that would count. But the generalized tax work or other work does not count and is not able to be taken as a QRE. But that's one of those other good things that accountants can help you is with that calculation. The recapture period. So as I mentioned, the credit used to be taken 100% at place in service, which placement in service is the date at which the building is substantially ready for its intended purpose. So if you need a use permit, you have to have that. If you don't need a use permit, then you can accidentally stumble into being placed in service if you start operating. The other thing to think about there is that you can also not be placed in service if you are thinking about that, because if you need an elevator or something else that's just not in service. So you have to really think about what is your intended use and are you ready for that? And that's the date that the credits begin. And like the old days where you used to get 100%, you now get 20% each year. And then you also get that recapture, which is burned off. And the recapture burned off at the end of the compliance period. So then you can feel safe that after 5 years, you have done your work and you are going to keep that benefit to your property. The things that can cause a recapture are obviously sale of the property by the owner that took the credits, and also for entities that have that investor, sale of the interest in the underlying investor can also trigger a recapture. So you have to look at who's taking the credits and think about their staying in their seats for that 5-year period. Also, of course, since it is a historic building, if your building burns down, that is one of those unfortunate things that you can use insurance proceeds to rebuild and avoid a recapture. But if you can't do that because of the destruction of the property, then that is also a recapture event. So there are some ways that are pretty evident to recapture and some that are a little bit of that foot fault. The federal historic tax credit, as we sort of, and I don't know if our faces are over people's screen to see the dollar amounts over at the side, but if we are, then you can just move us around. The historic tax credit expenses, my faces are over the side. So let me see if I can make sure I move us. There we go. So the example that we gave there is a $10 million project with QREs of $8 million. So your tax credits are 20% of that 8 million at a 1.6 million. And then I've talked about several times that typically these are done with an investor. And so the investor will charge anywhere from 70 to 80 to 90 cents. And that depends on how important this project is to their portfolio, whether they have other reasons to be investing. And frankly, as we talked about, because they are investing in a business, sometimes the price can go up and their equity returns can go up as well. So that credit price is typically just priced for your historic tax credits, but because the equity investor is required to be a partner, I've seen these structured in different ways where there's more or less return, but there is required to be a priority return for historic tax credits or a profit motive. So those investor returns are a little bit more than in projects. If you've done a new market tax credit deal, they're not really driven on there being a priority return. They can invest in two different ways, and I think this is not time to get into too many of the details. So we'll get into the polling question.
Yep, we'll jump in the polling question and then hit structure law.
Yeah, great. So the federal historic tax credit equals what percentage of the QREs? And one of those answers used to be right, and it isn't anymore, in case you're wondering. We used to have two answers on the board, and now we've only got one. I don't think that you get any points off for guessing wrong. Is that right, Pete?
That's right. All you have to do
So-
is answer. You don't have to be
so
right. So
All you have to do is show us you're awake and put it in an answer. So if you don't know, just go ahead and plop something in there and we will move on. Do we have enough people answering so far, Pete?
we're close. Get a couple more. I think it'll close out here in a second.
Okay, if you're not listening to us, we're closing now. All right,
Perfect. So 20% is in fact the current credit value.
that's right.
And so now we will roll on to the next slide.
Right. So as Pete said, 20% is the current amount. The old provisions for 10% have been taken away with that Tax Act a couple of years ago. And now we can talk a little bit, and we won't get into too much detail because again, this is only an hour, and I teach about historic tax credits and take a couple hours with folks on this because it can be pretty complicated, but let's just break down the simple basics. And I think the two main structures that we look at are a direct investment into the underlying owner or the master tenant structure. We typically see that this will be driven by the investor and or the developer, who one or the other has this is the way we do it syndrome. We don't vary from it, and this is how we're going to go. So if you're thinking about this and you want to direct this as a developer, then you're going to want to put that in your materials as you get started with your project, because typically I see most investors have a comfort level with one of these or the other. I find most of the main investors do want the two entity structure where they invest in an entity that is called the master tenant. That structure or I'm seeing it starting to be called as the prime tenant. So if you're wondering whether that comes from there's some rebranding in the industry. So we're talking about the same entity when we talk about the master tenant or the prime. We are passing through the tax credits to the tenant, and also then the tenant is the one where the ownership is 99% by the investor. On occasion, I've seen the single entity structure work where the investor takes 99% ownership in the ownership of the building directly. They are then, that would imply the 99% owner for all of those pass-through items and the depreciation and losses and everything else. So that's all in there. And also there is a flip structure, and that comes from the renewable energy tax credit side. And that flip structure means that they can go from 99 to 5%, if I'm remembering correctly, Pete. So they can't go all the way down to 1 at the end, but they can go down from 99% to 5% of their interest in 5 years. That master tenant structure allows you to put the investor one level removed from the ownership and divide up those benefits a little bit more. And also then the master tenant then has its subleases. So typically you'll see there'll be a property management entity in there because investors don't want to have to be responsible for leasing. Anything else on that before we move on, Pete, that you wanted to hit?
No, I think that covers the basics of it. And obviously we could go into a 2-hour presentation with graphics and everything else, but just know that there are a couple of different ways to work on that.
And again, you know, that each way is valid. There's ways to structure around anything you want to do in either of those structures. But I find if you're dealing with a seasoned investor, they're going to have their way picked out for themselves. So talk with them early if you want it to be one way or the other.
Yeah, and Laurel, I would just say from the project side, it's also a good exercise to talk to more than one investor. No different than talking to more than one bank. One of them may prioritize the deal higher from a pricing or structure standpoint than another. And so getting multiple bids and multiple potential partners into the conversation early is valuable.
Yes. And that is where hiring folks to help you along the way can be really beneficial, because they can introduce you to multiple different investors that may have different priorities. So that is one of the things that we do at the Tax Advantage Group by Cherry Bekaert, but there are others that also provide that service, and also accountants and lawyers can help you think through these structures. So there's a lot of great resources out there, and give Pete a call if you have any questions on that. A couple things to be aware of, just again, hit the high notes, but we won't have time to go into these. The 50D acceleration of income rules were quite a big hit in the world a couple of years ago, and have been reams and reams of paper written on those. So we won't cover that too much. The historic boardwalk hall case caused a lot of upheaval as well. And that one I actually just think of as the IRS saying, no, we mean it when we say you have to actually be a partner. So I actually didn't find it as earth shattering as some folks did, because I took partnership tax and I understood what those rules were and the meaning of behind that. But I think for a lot of people, they were thinking about this and they were even calling them strip credits, you know, stripping off the credit. That IRS clamped down on that a couple of years ago with historic boardwalk hall and said, no, you're a partner in an interest. And if you want your credits, you're going to have to remain. So having meaningful stake in the upside and the downside. So you can't just collar yourself into your risk. And then the first one on the side, but I worked my way up from the bottom, is really that nonprofits and historic tax credits can be very tricky. There are certainly ways that nonprofits participate. There's an entity blocker structure where nonprofits can create a taxable entity to be involved. There are ways that there are particular leasing structures that can be involved with historic tax credits and nonprofit leasing tenants, but it takes a lot more structuring and thought at the beginning. So remember that if there is a tax exempt entity, either in the ownership or in the use of your building, you're going to want to think about that very early in the structure and talk to some tax counsel that can help you on that structuring. Okay, so that is it for the federal tax credits, state tax credits. I think I'm going to need to just breeze by these state credits a little bit faster, since I don't want to not have Pete have plenty of time for new market.
We're in good shape, Laurel.
Okay. So the state historic tax credits, this is something that, you know, we put on the South Carolina statute just so that people who are in the region can be aware that there is a credit in South Carolina. There's one in Missouri where I am in St. Louis, and there are state credits around the country. These typically mirror in some ways the federal credit, but they also can be more particular or more user-friendly. So in some states, you can get the historic tax credit for personal residences. And in some states, you have to have income producing property. I think that for the South Carolina credit, we put a few of the basics on there. It's a 25% credit if you cap it at $1 million, or you can have a 10% credit and no cap. The credit periods are taken over 3 years. And for this, again, it has to be property that's income producing. There are typically, the way that these are structured, they do typically look at the National Park Service rules on what qualifies as buildings and QREs and things along those lines. But just check out your local rules. And then the other thing is to think about, and for those state tax credits, is there's a difference in the amount. And some of them have been requiring over the years because they don't just want surprises. So Missouri in particular used to have an open program and you could just show up, and that wasn't very good for our revenue stream to not know that we had a bunch of historic tax credit projects coming online. So you now have to get a pre-certification. And by the way, if you don't, then they aren't going to give you some credits. So, and you have to follow a sort of like check the box and follow their procedure rule. So that is something to be thinking about where you are, is to look at those early to make sure that if you have a pre-registration, you need to go get authorization, you need to be a part of a pool, that you're thinking about that. And that is actually a good segue into our next slide, which is about other state tax credits. And this really is a lesson in think early and go talk to people at the very early end of your project, because you never know what's available in your backyard. Legislation comes and goes in some states based on their revenue raisers and where they are in their budgeting process. With the different incentives that have come out in the federal level, I've seen a lot of money be held up at the states. They just haven't spent it yet. So go and see what money you can break off from your state governments, but there are lots of credits that are permanent. So some of those that are in there that we've mentioned are the Georgia Film Credit, which that's a fun one. If you're in Georgia, there are some film credits in other states. Michigan had one and then it went away and then they had one. So again, some of these are there and you can kind of count on them. And some of them are one of those that are sort of lobbied. So I think that Pennsylvania had a credit, and you had to sort of know when you wanted your project because they were rolling it in over a few years. So you just have to look at it and be willing to be planful. South Carolina has a couple of other really interesting credits. There's the one that I've heard referred to as the mill credit. That, if you, self-explanatory when you call it that. If it's a mill building, you can seek that credit. And Pete's our resident expert on the mill credit, so I'll let him speak on that if he wants to say anything else there.
Yeah, I would just say with respect to those mill credits and the abandoned building credits, they both have particular rules similar to what you mentioned in Missouri with the historic tax credit. You have to, there's not necessarily a cap, but you have to pre-notify the state that you're in process. And then just a note on I mentioned with the historics, it's important to get multiple investors. I had a note in my email box this morning from an investor who's looking for 2022 credits, and they're paying well in excess of 60 to 70 cents. They're up around 87 cents for some South Carolina credits because they've got investors who are hungry for them. So it is important to shop around and look around and not necessarily rely positively or negatively on historical information. When your project's ready, let's go out and see what we can find. But they all have their own nuances, and every state, like Indiana, has the Dino credit. New Jersey has credits. There are lots of programs, and anytime you can use somebody else's money instead of, as we like to say, instead of digging in your own sock drawer for some cash, it's a good day from a development standpoint.
Yeah, I would say that the thing that I think is interesting is that in different areas, they incentivize things differently. And so that's really important to know. In Puerto Rico, there's a tourism tax credit, and that has changed about 3 different times over the last 5 years, whether you can get it up front, whether you have to wait and be invested, whether, it's in the property level, whether it's somewhere else. So some of those things do change. And in particular, so for like the Illinois New Market Tax Credit, you have to go have an entity that applies for those. You have to then get it from a community development entity, which Pete's going to go through, and then you have to be a particular type of project. So if you sort of fit the box of what's going on, you can certainly get credits, but there's also, again, just the ability to go and talk to the development agencies and think about what you're trying to get done. And I found that in most of the localities I've worked, that's their job, and they're really excited to have people come in and be able to pitch you, put together a proposal, think about what they can do for you, especially if you're going to be creating jobs or bringing online historic buildings, or if you're going to be bringing services into their community, they want to see how they can help you do that. So The last thing I'll mention about state tax credits, because I hit it on the federal credit not being a strip credit, not being saleable, is some of those state credits, especially I know in Missouri, we have some of those that are transferable. So they're certificated and they're just like any other financial instrument. You can buy that credit on a particular price and you don't have to have an ownership interest. So that's one of those unique things about state credits that doesn't come up in federal all the time. And with that, I will turn it over to you, Pete.
Yeah, perfect. So the last big topic we're going to hit on is new markets tax credits, and that's where I spend the majority of my day. I love it. I could talk about it for hours and hours and hours, but I promise I won't. We'll get you out of here on time. If you're looking at your clock and thinking, got another topic. So the new markets tax credit was effectively designed as the corollary to the federal low-income housing tax credit. The government was really pleased with the results of that program in terms of generating quality housing in low-income communities, but quickly recognized that without doing something to stimulate the creation of jobs, the availability of goods, and the availability of services in those same low-income communities, you've given someone a really nice place to live, but you haven't really changed their daily life routine significantly. So they created this program, which is administered through the CDFI fund, the Community Development Financial Institutions Fund, which is a department of the Treasury that no one's ever heard of, that oversees community development financial institutions primarily, and through that also oversees this new market tax credit program. It's a unique public-private partnership where private community development entities, CDEs, apply for tax credit authority and then administer the program. It's highly competitive. Up until 2 years ago, there was $3.5 billion worth of transactional volume, but that was spread across all 50 states and the territories. So when you start really dividing that out, it's a pretty thin amount of transactional volume nationally, and highly competitive amongst the CDEs that are involved in the program. So real quick, we'll hit polling question number 4. Which Department of Treasury oversees the new markets tax credit program?
And Pete, while we're on a pause, I was just checking our chat function and realizing that we were supposed to encourage you all, if you have questions, please type those in the chat and let us know. We'll be happy to take a little time to answer anybody's questions.
Absolutely, and you can put it in the chat or in the Q&A box. We've got them all open and are happy to answer as we go along. I'll give a shout out to David Nielsen for encouraging humor on any day that ends in Y, which I agree with wholeheartedly. So looks like we've got just about all of the answers in on the poll, and folks are doing a good job of hitting the right answer. The CDFI fund administers the program on the front end. So why do we care about new markets tax credits? Because in a perfect world, they can provide gap financing for up to 17 to 20% of your total project costs. We'll talk a little bit about structure, but that money gets paired or leveraged with your own funds that you're bringing to the project, whether those are owner equity, debt, grants, proceeds from the sale of buildings, lots of different things we can lever in to get you a full capital stack. The way new market tax credits come into your project is a little bit of a misnomer, unlike the historic tax credit where your project itself earns a credit and then you offload that credit to an investor to turn it into cash. In this case, community development entities actually have the credits, offload them for cash, and then loan that money into your project, typically subordinate loan, typically interest only for 7 years at a very low interest rate. And then typically that loan will be sold back to the project for $1,000 at the end of the 7-year new market tax credit compliance period, which means you get cash on the front end, clean up your balance sheet on the back end. So the actual process, I mentioned it's highly competitive. There are about 300 CDEs in the country active. There are more than that, but those are the active ones. And each year they file an application, like a very large grant application to the CDFI fund, and it goes into this black box at the CDFI fund, and at some time later, the CDFI fund announces which CDEs then get allocation authority to finance projects. So as a part of that application process, they submit a pipeline of qualified projects, and all throughout the year, CDEs are meeting with real estate development companies, operating businesses, nonprofits that are looking to build new facilities or expand existing facilities to find projects that are creating high impact results in low income communities. They then, when they win allocation authority, apply that authority to qualifying projects to encourage investors to invest in the CDE. In exchange for that qualified equity investment in the CDE issues tax credits to an investor that they take over 7 years. And then, as I said, the CDE then uses the proceeds of that equity investment to make a loan to your project for a 7-year period. Typically, those get sold off, as I said, sold back to the project for $1,000 at the end of year 7. So where can you take advantage of this 17 to 20% subsidy? In low income communities, which are defined by statute as communities with poverty greater than 20% or median family income less than 80% of average. And that average is a little different depending on whether you're in a rural area or a metropolitan area. That's the baseline of qualification. But as I said, it's a highly competitive industry. So one of the competition differentiators is whether you're in a merely qualifying track or in a track with higher distress. On a primary basis, if poverty is greater than 30%, median family income less than 60%, unemployment more than 1.5 times the national average, or the county in which the tract is located is non-metropolitan, you're going to be higher distress. Otherwise, there's a laundry list of things that if you check any 2 of those boxes, you are also qualified for higher distress. Those are things like an SBA hub zone, if you're using SBA hub zone financing, a USDA food desert, a FEMA disaster area, an opportunity zone, a promise zone, other state or local incentive district, lots of different ways you can comply there, but being in higher distress makes your project more attractive and competitive. So I know we're talking about real estate today, but as you think about developing real estate, you can develop it for any of these categories in job creation, whether that's workforce training, industrial, that's creating living wage jobs, other types of workforce development. It could be grocery anchored retail. It could be office space for locally owned. It could be mixed use with some housing, some office space, some retail. It can be charter schools, primary schools, workforce development facilities, government sponsored opportunities, whether that's a government office building or an industrial park building that's being built for the benefit of workforce development. Could be hospitals and health clinics, or it could be any kind of not-for-profit that's expanding. Additionally, this really doesn't necessarily work on today's, but you can do business loans or working capital loans. But just remember, project size for new markets to work really needs to be $5 million and up. It's a complicated program, and it is one that comes with a significant amount of work that makes something smaller than 5 million difficult. So can new market tax credits financing be used in conjunction with other tax credits? We're getting a lot of items, a lot of answers in quickly here. It is a very flexible credit, if that's a good hint for you, since I may not have specifically addressed that. So as our polling questions are ending up, we're getting ready to get into our sample project. But when you think new market tax credits, just remember it starts with geography, and then that's the lead. It has to qualify geographically. with one minor exception I won't bore you with today. And then secondarily, really gets into what impacts you're creating for low-income people in a low-income community, which can be varied and wide. So lots of opportunity to take advantage of it.
And Pete, I think
Okay.
this is our last question, so hopefully
It
people got
is.
their answers in.
So we got
Go
them
ahead.
in, and if you answered 3 out of the 5, you got enough for the credit. So I was
Good.
over exuberant in the number of poll questions I stuck in. So thanks for hanging with us on those. So now we've been talking about a lot of theory and a lot of rules and that sort of thing, but let's talk about a real life scenario. This building that you see 2 pictures of exists in Winnsboro, South Carolina. That's in Fairfield County, South Carolina. If any of you had seen the news a couple years ago, the local power company or the state power company and Westinghouse were working together to develop a huge new nuclear power plant in South Carolina. It was in Fairfield County. Fairfield was counting on the property tax revenues from that in order to help them support redevelopment of several office buildings they had, government office buildings they had that were over 80 years old. Parts of the sheriff's office had offices that rained inside when it rained outside. But they fairly poor county that really needed a boost. And when that went kerplutz, it was a terrible meltdown. That's maybe a bad phraseology. Halfway through construction, the financial cost of the project got squirrely and it ceased, and there is no nuclear power plant in Fairfield and thus no tax revenue. They were really stuck on how to get new office buildings. A private developer came in and partnered with them to rehabilitate what used to be the Mount Zion Institute, which had, just a quick historical note, the distinction of being a headquarters building, not this particular building, it actually burned and rebuilt, but a headquarters building for both sides in both the Revolutionary and Civil War. So a lot of history on the site and an interesting building. $13 million project. You can see the interior of the gymnasium, which was in desperate need of a rework. But the county government owned it. As Laurel mentioned, it's hard for a county government or a nonprofit to take advantage of tax credits. So this developer came in, acquired the building, redeveloped it through the use of federal historic tax credits, state historic tax credits, state abandoned building tax credits, and new markets tax credits to put in several government offices, consolidate. It's now located downtown. It brought over 100 jobs into the downtown core of Winnsboro, which is the county seat, which will not only get more people moving and activated and employed, will bring economic activity to the downtown community. So what's really interesting about this is, that original capital stack where we looked at developer equity of roughly 20%, permanent debt of maybe 70%, and then in our very early slide, another 10% of subordinated debt. Look at how this flips when you start taking advantage of tax advantaged sources of capital. You've now got $3.9 million new market tax credit investment, 1.6 in state abandoned buildings, 775,000 in state historics, $1.7 million in federal historic equity, $5 million in debt. So now only 50% of your capital. So this just shows you how you can flip the capital stack in a project significantly from our earlier and original. That original where you had significant developer equity, lots of perm debt. This has completely flipped that table with all of your tax advantage sources. And with that, we can see if there's any Q&A, but I think our 50 minutes have just elapsed.
All right, well, we can certainly open it up if you have any Q&A, Pete, in the chat box or Q&A box. Maybe we've got a couple minutes and see if you can answer those. And then otherwise, we can wrap it up if there's none there.
I have been looking at the slides while you were talking and the chat and the Q&A, and I don't see any open questions. But if somebody has one, feel free to pop it in there and we'll be happy to answer. Also, the last slide has Pete and my contact information. So if there's a question that you wanted to ask, but you didn't want to type it up to everybody, or you just want to check in with Pete, he'd be happy to help you with any of your projects and walk you through any of these in more detail.
Okay, well, with that, that concludes our final session of this conference. At Cherry Bekaert, we're committed to offering a series of resources and programs designed to share industry best practices while limiting your financial burden. We appreciate your participation over the past week and hope you found this year's virtual conference beneficial and useful to you and your business. Thank you again for joining us. If you have any additional questions, as Laurel mentioned, please feel free to reach out to them with their addresses, or feel free to reach out to me and we'll make sure to get you connected. We want to keep the conversation going and support you in any way we can. Also, we value your feedback and ask you to take part of the short survey, which will appear when you leave the session. Hope you have a great weekend, and hopefully we'll talk to you soon. Thank you.